The
Not
question
the original
is,
King Richard III on the
yeah,
planet. But,
the question is withdrawal rate and its corresponding estimated years of retirement, i.e., early and late retirees with a 100% equity position in VEQT. All right, so that's an interesting question. Uh, the original safe withdrawal rate analysis from Bill Bengen, who we have had on this podcast talking about that research, looked at a 30-year horizon and it focused on US stocks and bonds only. And that's what led to the famous 4% spending rule that people like to talk about. Looking at global stocks and increasing the time horizon does affect that 4% number. So I do have a model set up. I was fortunate for King Richard the Third. I have a model set up to basically answer this question. It looks at global stock data, so not quite VEQT, which has a Canadian home bias. This just looks at global market cap data from 1900 through 2023. And I can easily manipulate the time horizon in that model to see how it affects the safe withdrawal rate. So at the 30-year horizon, I get a safe withdrawal rate of 3.5% with a 5% failure rate, which is typically how that type of analysis is done. If I hold that,
I
yep,
was just going to say before we go further, because we should probably clarify here, right? So that Bill Bengen 4% spending rule was based on a balanced portfolio, right? I
right,
think it
yep.
was 50-50 stocks and bonds. So if the questioner here is asking about what it would be if you had 100% equities, would you not expect the safe spending rate to be higher than 4%, not lower?
With equities?
Yeah. I mean, obviously you have much more volatility, but you also have much higher expected returns.
Yeah, so
So, yeah, you would presumably, if you took additional risk, be able to withdraw larger amounts over time. But
it,
that's
it,
doesn't sound
it
like what you're initially seeing
well,
here.
so one important point there is that I'm using global stock data and Bill Bengen was using US stock data.
And it makes that much of a difference. Yeah.
That makes a
Yeah.
big difference.
Okay.
If I included US bonds in this specific projection, like the 30-year horizon, I could probably get a little bit more out of this, but that's US bonds specifically.
Hmm.
If you look at like the Scott Cederberg research, adding bonds from a broader sample would make things look worse universally. So it
Okay.
really does depend on the data inputs that you're using, but it is a good point. And I do think that the volatility can matter a bit with the safe withdrawal rate uh, because you're withdrawing a fixed amount each period. So if you have big drawdowns and you keep withdrawing the same amount, that can be really bad. We've talked about this when we covered the concept of variable withdrawals. I think one of the terms that we used was we shouldn't be calling this sequence of returns risk. We should be calling it sequence of withdrawals risk
Mm.
because if you withdraw the same amount when markets are really bad, that's really what hurts you more so than the bad return. It's withdrawing the same amount when returns are bad. But I do
Okay.
have some comments on variable withdrawals in a sec. Um, okay, so as that baseline, I get 3.5%, which is I don't think that's a new finding or a exciting or controversial number. That's like other researchers have found the same thing. That if you go global, it drops to around 3.5%. If I hold that safe withdrawal rate constant, I get an 8% failure rate at a 35-year horizon, a 14% failure rate at a 40-year horizon, and a 16% failure rate at a 45-year horizon, 21% at a 50-year horizon. So you can see holding the spending rate constant, the failure rate, as you kind of expect, is increasing at longer horizons. I did look past that, past 50 years, and the failure rate does continue to increase, but it increases at a slower rate. Be interesting to put that on a chart. I did not do that, but I think it'd probably be an interesting looking chart. Um, okay, then if I flip the perspective to safe withdrawal rates holding the failure rate constant, so I hold the failure rate at approximately 5%. The safe withdrawal rates I get 3.2% for a 35-year horizon, 3% at a 40-year horizon, 2.9% at a 45-year horizon, and a little over 2.8% at a 50-year horizon. So you can kind of see why uh, when people are talking about the 4% rule for an early retirement, it's, you know, 4% is probably too high
Mhm.
if you extend the sample past just US data, but it's probably way too high if you're looking at a much longer time horizon, which an early retiree would be.
I think most people would be surprised by how low that number is. I'm a bit surprised, to be honest. Now, these are inflation adjusted withdrawals, we should say. It doesn't mean you'd withdraw the exact same dollar amount, of course. It's you withdraw the same amount in real dollars
Yeah, that's
over
right.
decades. But
Yeah.
still, that is not a big number, somewhere in the
And
neighborhood of
it's based on the
3%.
starting portfolio. So if you have $1 million
Right.
and you're withdrawing 2.8%, that's $28,000. And the way that this concept works, the way the safe withdrawal rate works, is that you're withdrawing that initial amount, $28,000, adjusted for inflation or deflation every year thereafter. So it's a constant inflation adjusted withdrawal where the dollar amount is based on the first, the starting portfolio value.
Yeah, I think when you consider that, if you were able to save $1 million, you could reliably withdraw, let's call it somewhere between $28,000 and $35,000 in real dollars indefinitely.
In the worst case, like that's one of the challenges I think with the safe withdrawal rate is that it is based on the worst historical outcome. Now, that's challenging for a couple of reasons. One, because the worst historical outcome is not necessarily the worst future outcome. So
Mm-hmm.
this could be risky. And then on the other side of it, and historically this has been more the problem, is that the worst outcome doesn't happen very often. Like by definition,
Right.
and so we'll see when we talk about variable withdrawals in a second. The average amount you can spend is a lot higher. You just don't know if you're going to get the worst outcome or not. So under this safe withdrawal rate idea, you're withdrawing a very conservative amount because you're planning for that worst case scenario. But I think there are other ways to approach that. I did try going in the other direction. I looked at a 20-year horizon. So if you're retiring very late or have a short life expectancy for some reason, and I did get a little over a 4.4% withdrawal rate with a 5% failure level. And the Scott Cederberg's paper does mention the failure rate under 4% withdrawals for their optimal 100% equity portfolio, which is the 1/3 domestic, 2/3 international. And the failure rate there was 7%. Now their time horizon is different. Like I'm using these kind of fixed time horizons to look at how it affects the withdrawal rates, but their data setup is based on a couple retiring at age 65 and then being subject to the distribution of mortality for U.S. residents. So they're modeling a whole bunch of different life expectancies. But looking at their numbers, on average, they'd be living less than 30 years. Yeah. But it's a similar kind of range of numbers, I think. Now that safe withdrawal rate model that I have is also set up to look at amortization-based withdrawals. I think that's quite interesting to see how they change relative to safe withdrawal rates with an increasing time horizon. And if people want to learn more about amortization-based withdrawals, they should listen to episode 340 with Ben Matthew, where we went very deep into into safe withdrawal rates versus amortization-based withdrawals. So in short, it's a variable spending policy that's designed to deplete the asset at the end of the target horizon, but not before. And it does that by adjusting each year to changes in the starting portfolio value of that year and expected returns. Now, my version of this model holds expected returns constant. At the 30-year horizon, amortization-based spending is on average 7.6% of the starting portfolio value. That's on average for all of the 30-year periods that I looked at from 1900 to 2023. The worst 30-year period has average spending of 3.6% of the starting portfolio value. And the worst single year is 1.5% of the starting portfolio value. So again, back to the $1 million example, there was a year in there where you had to spend $15,000 to follow this rule, which is like, that's rough. But on average, you spent a lot more. The fifth percentile single year spend is 3%. What's that?
More than double, right? Like the average at 7.6%. That's
right.
A lot more than the 2.8 to 3.5 we were talking about before.
Right.
So it is interesting, right? Like this idea that if you want certainty and consistency, you have to be very conservative. If you're willing to be a little bit more inconsistent with those annual withdrawals and kind of recalibrate every year, chances are you're going to be able to spend a lot more.
Yeah, yeah, exactly. I did look at a 40-year horizon too, and that drops average spending to 7.4%. So 7.6% at 30 years, 7.4% at 40 years on average. And the worst 30-year period was just under 3.1% at 40 years compared to 3.6% at 30 years. And then the worst single year was 1.4%. The fifth percentile year was 2.6% of the starting portfolio value as a spend. Yeah. And so it is important to emphasize that under amortization-based withdrawals, the spending amount is changing from year to year, whereas with safe withdrawal rates, like you just mentioned, Dan, is constant.
Yeah. The challenge, of course, as a retiree who's actually spending that money, nobody wants to be on a extremely variable annual budget
Totally.
where they have to dramatically adjust their withdrawals based on last year's investment returns.
Totally. Yeah. Even in that fifth percentile. So say you have a bad year and well, the worst 30-year period has average spending at 3.6%. So in the worst year, you're spending on average a bit more than the safe withdrawal rate spending, but there is a year within that 30 years where you have to drop spending down to $15,000.
Right.
1.5%, which is like that's a big cut.
Yep. Yeah. I mean, if it was only 1 year out of 30, you'd probably be able to adjust, but you just never know when that year is going to come.
Exactly. Yeah.
If that's the year where you booked your big trip and you have to cancel it because it doesn't meet your scheduled withdrawals. I mean, that's a specific case, but I mean, I think we've talked about it before. Most people naturally resist the idea of these variable spending plans.
Yeah. Yeah. I think any spending rule is tough. I'm pretty sure I talked about this on the Morningstar podcast because they asked about spending rules and withdrawal rates. And I just don't think that a rule works for an actual person. Like it's really fun to analyze. Like this is cool data to talk about. And it's neat to see how flexibility affects spending and what the trade-offs are. But like for you or I to sit down with the client and say, no, you can't do that this year because the rule says so. Like it's just not going to happen. It doesn't make
you might
sense.
be able to do it next year, but you can't do it this year. Like nobody wants to have a retirement plan like that.
Right. Yeah. So I think it's got to be a lot more human than a rule, but I do think that the rules help you think through what the trade-offs are.
Yeah.
All right. Next one.
You want me to take the next one?
Yeah, sure.
All right. This one is Ricardo from Italy, who asks, don't you think that the most difficult part about investing is to forget that you're invested? I mean, once you set your goals, asset allocation, and monthly savings, then then starts the hard part, the so-called boring middle. How can you forget you're in the market if we receive daily news from everywhere about everything? I think this is actually a pretty insightful question. So take it away and I'll chime in with some, first-person experience here as well.
Okay, cool. So I did have an interesting conversation recently that is relevant to this question. One of our portfolio managers came to me with this observation that he had these client cases where the client had either wanted to get out of the market or make their portfolio more conservative due to some external event. And this is all recent and, politics and stuff like that, just the general things that have been happening in the world. He'd had several interactions with clients that had come and said, hey, I want to get out of the market or I want to make my portfolio more conservative. And in all of the cases, he talked through what they were feeling and related it back to their financial plan. And in all cases, the client left feeling much better and they stuck with their initial asset allocation, didn't make any changes. But then the portfolio manager was kind of thinking about those interactions as he was doing other financial planning work for those clients. And he went and modeled what their financial plans would have looked like if they had moved to a more conservative portfolio. And then he compared the expected impact of that to the impact of other financial planning strategies that he was looking at implementing for them. And his observation, and this is why he sent me a message about this because he thought it was so interesting, is that it was really hard to find a financial planning strategy. Think of things like optimal withdrawal sequence from retirement accounts, for example, that had anywhere near the expected impact of a 10 percentage point increase in the portfolio stock allocation, or in this case, in not decreasing the stock allocation in the portfolio. Now, one exception to that would be the savings rate, which is kind of a necessary precondition for asset allocation to matter. Um, and so they made another interesting point as they were just kind of thinking through this, which is that he suspects that the risk tolerance. This is Jordan Tarasoff for what it's worth. He's been on this podcast in the past. He suspects that the risk tolerance of an investor in isolation is likely quite a bit different from the risk tolerance of an investor with an advisor. So anyway, all that to say, I agree with the premise of the question that kind of setting up a plan and doing smart financial planning and picking an asset allocation, those are all great, important, smart things to do. But I think it can be argued that their effects on the long-term outcome of a given plan or a given financial situation sit in the shadow of taking the right amount of risk and maintaining that level of risk through good times and bad. There is a highly cited paper in the Journal of Finance that's kind of on this topic. It's called Money Doctors. And the paper kind of acknowledges that the net of fee underperformance of professional money managers is a problem. Like that's there. We know that professional money managers underperform, but they look to answer the question of why people still pay for financial advice. Like if you look at us, we're an interesting example where, well, we're a little different because we use dimensional. You're an even better example, Dan. You're using index funds. Your clients are going to get the return of the index less the fees that they paid you. They must be deriving value from that fee because it's not to beat the market because they think that's explicitly not going to happen.
No, you're right about that. Yeah.
Yeah. And so in this paper, they say we propose an alternative view of money management that is based on the idea that investors do not know much about finance, are too nervous or anxious to make risky investments on their own, and hence hire money managers and advisors to help them invest. That's kind of basically it. So to the listener's question, I think financial advice can be one way to solve the problem of taking the right amount of risk and staying in your seat despite all the crazy stuff that's happening around you. Another solution could be automating as much as possible. When Morningstar analyzes the effects of cash flow timing on investor returns, asset allocation funds like VEQT and other single products that contain a diversified rebalanced portfolio, they have the lowest return gaps between product returns and investor returns. And that seems to me to imply that investors in those types of products, as opposed to managing their own portfolio, rebalancing across individual asset classes, may have an easier time behaviorally.
Yeah, I think, another element of this, there's a couple of things I think I would add. The first one is I think people who are naturally sensitive to volatility will probably tolerate a more risky portfolio if they're working with an advisor than if they worked with them on their own. So if you feel like you're going to be watching the markets on a daily basis and be very bothered by the volatility, sometimes working with an advisor allows you to, let's say, take a little more of a hands-off approach. You're delegating that to somebody else. I certainly have many clients who I've spoken to who went from being DIY to working with us and now have told me, I just don't look at it nearly as much as I used to. And I think we all know the less you look and the less you touch, the bigger your portfolio is going to grow, right? So I think that's part of it. I think this idea of, you had said to stay in your seat was the term that you're like, this idea that you would probably be more likely to change your asset allocation, I think, if you weren't working with someone who enforced the consistency, right? One of the things I hear all the time, and it isn't just from nervous investors, it's just people who want to get tactical, right? And sometimes it's like we should increase our equity allocation after the markets go down. And well, I mean, if you're going to do that, you might as well do it in that direction versus panic selling. But anytime you get into the business of trying to tactically change your asset allocation, I think you're asking for long-term erosion of returns. So this idea that if an advisor can help you build a portfolio that is still appropriate for you, but kind of as risky as you can comfortably tolerate and keep you there, those two things are going to make a big difference. Now, getting back to his question, though, I think the listener was sort of asking, well, okay, but that's very boring, right? Once you've found an asset allocation that you're comfortable with and you're sticking to it, I don't know what to say about that, but I do think you're right that the financial planning strategies, even if they don't have as dramatic of an effect as a change in asset allocation still do have some value in that they keep you focused on the right things, right? And so they keep you focused on the saving, the tax efficiency, the discipline, and all these sorts of things that an advisor can help you enforce. And none of those have anything to do with investment returns, but they do have long-term value. Yeah,
That's a really interesting point.
The boring middle is good, right? I mean, the boring is the place to be in investing. If your investment portfolio is exciting, you're probably doing something wrong. So embrace the boredom. And if you're restless and you need to do something, do it on the margins and on, like don't do it inside the portfolio. Try to focus on other areas of your financial life that, you can do less damage.
I really like that point of letting financial planning be the interesting part. Let the investing be boring.
I find it now, like for so many of the clients that I've been working with for many years, in our review meetings, like we don't spend very much time talking about the markets or the portfolio. I mean, we do the usual. We review the portfolio, we review the returns. Nobody's surprised because that's one of the benefits of using an indexing strategy. Everybody knows what the performance is going to be if they've been following the markets. And then we get on to what really matters in their life. And that's the things that's much more interesting. So,
yeah, no, that's true. And solving little problems about how to best accomplish whatever this thing that they want to do that year.
Yeah.
I cut my quote short from that paper, and it actually echoes one of the things that you said. So the paper says, net of fees, investors consistently underperform the market, but experience less anxiety and earn higher expected returns than they would have by investing on their own.
No, that nails it. That's exactly it. Yeah.
Yeah. Yeah. It is a good question, though. I agree that is an insightful one, because it can feel like there comes a point where everything's set up and everything's kind of done, and then what's next?